Industrial and Commercial Bank of China leaks regulatory data, faces over 1 billion yuan fine from US. Massive demolition in Xiong'an new area leads to numerous villagers detained during extensive protests. China's epidemic death surge, public outcry grows against CCP concealment. China's stock market encountered Black Monday, a total annihilation. It's all covered in today's China Truths. Industrial and Commercial Bank of China leaks regulatory data, faces over 1 billion yuan fine from US. China's Industrial and Commercial Bank, ICBC, along with its New York branch, recently incurred a fine of $32.4 million from the United States for the unauthorized disclosure of confidential regulatory information to foreign regulatory authorities and non-compliance with relevant laws. Additionally, it was discovered that a former employee had been instructed to expedite the implementation of numerous documents, a matter that the bank failed to promptly report to the authorities. According to an announcement from the New York State Department of Financial Services, NYDFS, on the 19th, this latest move concludes an investigation into their violations related to the Bank Secrecy Act/anti-money laundering and breaches of New York laws. NYDFS noted that, aside from the fine payable to the state of New York, ICBC is obligated to devise a written plan detailing the enhancement of compliance policies and procedures. The Wall Street Journal quoted ICBC's response, affirming that remedial measures have been taken. However, the settlement with the U.S. does not necessarily reflect the regulatory compliance and internal control status of the New York branch. ICBC emphasizes that compliance with regulations and risk management remains its foremost priority. On the day ICBC received the fine, the U.S.-China Financial Working Group meeting in Beijing also concluded. A press release from the U.S. Treasury Department on the 19th highlighted that this meeting marked the first of the year for the group and the inaugural occurrence in China. Massive demolition in Xiong'an new area leads to numerous villagers detained during extensive protests. China's heavily invested Xiong'an new area, touted as a millennium project, spearheaded by the Chinese Communist Party, is currently grappling with a declining population and economic downturn. Over the past 6 years, the counties of Xiong'an, Rongqing, and Anqing in Hebei have witnessed ongoing large-scale demolitions. Villagers revealed that local governments opt for partial demolitions to prevent entire villages from being cleared simultaneously, hindering residents from receiving compensation. This approach has led to the arrest of numerous villagers voicing grievances, including those from Baiguan and Qiaobei. According to Mr. Liu from Anqing County, if one household refuses to move, there is no compensation, including pensions. Public records indicate the construction of 1,769 buildings, housing over 90,000 resettlement units in the Rongdong, Rongxi, and Xiongdong resettlement areas. However, online videos expose substandard construction quality in these buildings. Each person is allocated 50 square meters in the resettlement units, with an option to purchase an additional 20 square meters at a discounted rate of 7,000 yuan, about $987.36 per square meter. However, residents face challenges in affording additional fees for public areas, including property management, parking, and heating, especially amid rising unemployment. Many are unable to petition, and their information can't get out. Mrs. Yang from Rongqing County notes, while many resettlement buildings have been constructed, a considerable number remain unoccupied. Commercial areas and markets have few patrons. Although deemed mandatory, no visible influx of residents has occurred. Progress is sluggish, and numerous planned constructions are yet to commence. The school has merely installed its gate, the interior remains unbuilt. Many projects may have stalled due to insufficient funds. China's epidemic death surge, public outcry grows against CCP concealment. In recent months, hospitals across China have consistently been overwhelmed, with the number of infections and deaths from the epidemic steadily climbing. However, the CCP authorities refrain from reporting, testing, and taking decisive action on the current epidemic, leading to widespread anger among the populace. One healthcare worker from Tianjin told NTD television, "Currently, there is no reporting, no testing, and no action. They simply don't prioritize it. I've heard there are more cases of white lungs. It's just that they officially do not acknowledge it. Another resident from Ningbo, Zhejiang province, added that 2 people in their unit died. The unit doesn't allow any noise, and they don't know the reasons. Both were in their 30s, both were boys. On January 19, renowned Chinese media figure Zhao Jing died suddenly of a heart attack in Beijing at the age of 44. Netizens suggest that Zhao Jing likely contracted the virus, leaving behind lingering effects that triggered other sudden illnesses leading to his demise. Incidences of strokes and heart attacks after the epidemic have become all too common. On January 17, the Wall Street Journal reported that the House Committee on Energy and Commerce in the United States, based on documents obtained from the U.S. Department of Health and Human Services, revealed that as early as December 28, 2019, researcher Lily Ren from the Institute of Virology at the Chinese Academy of Medical Sciences uploaded almost the entire structural sequence of the COVID-19 virus to a database operated by the U.S. government. However, it wasn't until January 11, 2020, that the CCP provided information on the genetic sequence of the COVID-19 virus to the World Health Organization. Senior current affairs commentator Tang Jingyuan comments, having access to this complete virus sequence means that the CCP already knew very well how strong the virus's transmission capability and pathogenicity were. The CCP treats any information related to potentially significant public health crises as an unstable factor to be concealed. In order to maintain the so-called stability of its system, it is willing to sacrifice the lives of many people. China's stock market encountered Black Monday, a total annihilation. China's stock market recently encountered Black Monday. Across the entire A-share market, all industries and sectors experienced a widespread decline, best described as total annihilation. In detail, based on market reports, a total of 5,253 A-share stocks fell, while only 153 stocks rose. The total turnover of the two cities was 794 billion yuan, nearly 112 billion US dollars. The Shanghai Composite Index once again fell below the 2,800-point mark, continuing to reach a new low in the past 4 years and recording its largest single-day decline since April 25, 2022. Even Hong Kong's Hang Seng Index fell by 2.3%, dipping below 15,000 points again, nearing its lowest closing point since 2009. The Shenzhen Component Index experienced its biggest decline on January 22, dropping by 4.06%, reaching a low of 8,430 points. It finally closed at 8,479 points, down 3.5%. The CSI 300 Index closed at 3,218 points on January 22, down 1.56%. The GM Index closed at 1,666 points, down 2.83%. The Science and Technology Innovation 50 Index fell 3.04% to close at 742.23 points. On that day, all sectors on the A-share market fell across the board. Among them, media and entertainment stocks fell the most, by more than 6%, steel, chemicals, petroleum, basic metals, real estate, and cement stocks fell by more than 5%, power stocks fell by more than 4%, coal and automobile manufacturing stocks fell by more than 3%, financial stocks fell by more than 1%. Notably, there was a significant scale of capital selling in industries such as electric power equipment, media, semiconductors, architectural decoration, securities, communications, and national defense military industry, with virtually no industry experiencing net buying. Regarding the current situation of A-shares continuing to plummet, the account at Keijing Shujuku posted on the X platform, GDP can be changed, unemployment data can be changed, but the stock market crash-like plummeting cannot be changed, nor can it be saved. The Chinese authorities have been boasting about the East rising and the West falling. Presently, the U.S. stock market is flourishing, Taiwan and Japan are also on the rise, while China is in hell. The slap in the face is too severe, echoing loudly. China's assets are in a profound crisis. If not addressed promptly, all will be lost. Social media influencer Chao Chi shared on the X platform that the substantial drop in the Chinese and Hong Kong stock markets on the 22nd implies several possible impending events. 1. China's economy is collapsing, and the future economic decline will be bottomless. 2. The probability of China becoming North Korea is getting higher and higher in the future, and it will no longer need the stock market, a product of capitalism and the market economy. 3. China's financial crisis is about to break out. 4. The internal strife among the top leaders of the CCP is intensifying, and unexpected big things may happen. The crisis of unrest is approaching. In the event of nationwide martial law, all transactions will cease. China's central bank directs state banks to support yuan amidst stock market plunge. According to exclusive information from Reuters on January 22, significant state-owned banks in China are taking measures to support the yuan. They are tightening liquidity in the offshore foreign exchange market while actively selling US dollars in the onshore foreign exchange market as the stock market faces a downturn. State-owned banks typically act on behalf of the People's Bank of China, PBOC, in the foreign exchange market. The objective is to prevent the yuan from depreciating too rapidly as the Chinese stock market undergoes a sharp decline, with the Shanghai Composite Index consistently plummeting. So far this year, overseas funds have offloaded approximately $1.6 billion worth of Chinese stocks, and investor confidence has been rattled by indications of a slowdown in the Chinese economy. On the evening of the 22nd, the offshore yuan-to-dollar exchange rate surged to a 2-month high, reflecting signs of tightening liquidity. During this upswing, state-owned banks in the offshore market have scaled back loans to each other, effectively tightening offshore yuan liquidity and elevating the cost of betting against the yuan. Simultaneously, state-owned banks are selling dollars in both domestic and overseas foreign exchange markets to prevent a swift devaluation of the yuan. China's stock market resembles a casino. Thomas Gatley, a senior analyst at Gavkal Dragonomics, noted to the Wall Street Journal that China's securities regulatory authorities are under significant pressure from Beijing to stabilize the stock market and restore investor confidence. While increased regulation may provide short-term stabilization, it might also dissuade institutional investors from injecting more funds into the Chinese stock market due to uncertainties about future selling capabilities, challenging the perception of the Chinese stock market as a well-liquidated capital allocation venue. Researcher Song Weijun from the overseas think tank Tianjin Politics and Economics pointed out that the practice of large shareholders cashing in after the lockup period has long been an issue in the Chinese stock market. This leads to a drop in stock prices and traps retail investors, reflecting that the Chinese stock market is not a normal capital market, and describing it as a casino is apt. Song Weijun bluntly asserts that such incidents will persist, constituting an institutional problem. The CCP will likely impose restrictions to stabilize the stock market, otherwise, a fund exodus could create a stampede effect, making it challenging to restore investor confidence once a trend is established. Investors are cautioned by Song Weijun that the majority of listed companies in mainland China are not worthwhile investments. Many companies go public merely to raise funds, presenting attractive financial reports. Once successfully listed, major shareholders primarily focus on cashing out. In extreme cases, companies may delist, and the maximum penalty from authorities is only a few $100,000. However, from listing to delisting, the funds of retail investors are siphoned off. In essence, the stock market is viewed as an economic barometer for a country, highly correlated with macroeconomic changes, and to some extent, even serving as a leading indicator of a country's prospects. However, after 3 decades of development, the Chinese stock market is labeled a policy-driven market and a money-raising market, indicating a malfunctioning economic barometer for the Chinese economy. Renowned Chinese economist Wu Jinglian emphasizes the primary issue with China's stock market is the high degree of information asymmetry. He introduces the stock market casino theory, stating that China's stock market not only resembles a casino but is an unregulated one where some individuals can see others' whole cards. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.